going to make mistakes when you get into investing. Everybody does, from Warren Buffett to George Soros. Being a good investor means you learn from your mistakes and try to mitigate your losses. In order to help you avoid the most common pitfalls, here's a quick list of some basic mistakes that new investors make. When you notice yourself about to make one, you can step back, regroup, and get back on track toward becoming the brilliant, patient, and cool-headed investor you're meant to be. Number 1, doing nothing. There are no guarantees in the market other than one. Not investing at all will not provide for a comfortable retirement. Remember, time in the market is much more important than timing the market. You don't need to make a huge decision regarding your life savings. Buy one share in a company that you love. After that, you can think about the bigger picture and start diversifying. Number 2, investing for the short term. The caveat to part 1 is don't invest with money you don't have. Buying one share to get you off the mark is all well and good, but don't go investing huge sums of money that you may need in the next year. Far too often, novice investors throw all their savings into stocks, thinking they can sell them off whenever they need the money back. This isn't a bank account. If you need the money in the middle of a downturn, you may have to sell for a loss. Number 3, playing it safe. If you're young, don't go investing solely in low-risk, low-yield stocks. You've got years to weather the dips in the market and reap the huge rewards. Older investors don't have that luxury. You know the expression, time is money? Nowhere is that more true than in the stock market. Use your time to your advantage and invest in companies with the potential for long-term growth. Try and invest in upcoming megatrends, like green energy, and find the leaders in the industry to buy into. Number 4, playing it risky. Conversely, don't go throwing all your money into risky companies, particularly overhyped stocks without solid business models or sound leadership. Spread your risk across a few companies and sectors to cover yourself in the event of a downturn, and have a few bedrock shares from larger companies to keep your portfolio balanced. Finally, number 5, following the crowd. If following the crowd worked, we'd all be millionaires. You're going to go through periods where every fibre of your being is telling you to sell a stock you still believe in because of some temporary slump. A bad earnings report here and there isn't going to be the downfall of a great company. Stock prices go up and down. Stick to your guns, and over time, you'll reap the rewards of a long-term investment strategy. Keep changing your mind, and your returns will be eaten away by trading fees. Avoiding these 5 common mistakes will put you well on your way to becoming a successful investor. As for the rest, why not check out the free MyWallSt app, where you can see some of the stocks that we believe will beat the market. You can find our best investing tips, market news, and in-depth analysis there too. Don't forget to like, share, and subscribe so you can see more of our investment content as soon as it's released. Until then, happy investing.